Um, so thank you for coming along today. So today's topic is about what you should be doing, thinking about doing before the end of the tax year, and also to give you some tips and ideas about how you can get ahead and plan for the next tax year. So the tax year ends on the 5th of April this year. Which is Easter Sunday, I believe. So we've got the bank holiday weekend in there to confuse things a little bit. So you really want to be making sure that you're taking action as soon as possible if there's anything that you find out that you haven't done that you should have done already. So I think, we're all aware just how much the tax burden is increasing on all of us. For a long time now, we've had the freeze on the tax thresholds, which means that more and more of us are being driven into different tax brackets. And, all other taxes are constantly changing, like tax increases in dividend tax rates, changes to the rules regarding IHT and pensions that is now just over the horizon in 2027. So there's more reasons than ever before that we should be aware of how much tax we're paying and what we can do to minimise that tax, because there are different tools and strategies that you can use and you want to take advantage of them. So today I'm going to talk about different strategies that you can use to save tax in the current tax year. And as I say, give you some heads up as to what you can do to plan for 2026, 27. So we're going to look at how you can pay less tax with regards to your income tax, any tax on any savings, investments that you have. We'll also just cover inheritance tax. More and more estates are being caught by inheritance tax now. So we'll talk about what you can do to minimise that. And then also maybe to give you some things to think about what you can do to avoid a last minute panic or rush and to take action earlier in the tax year and plan better. So we'll have time for questions at the end. I'll try and keep a wee eye on the chat box if anything pops up, but I might just get to them all at the end. So please pop it in there, or at the end, come off mic and ask if you've got any questions. So first of all, if we think about income tax and what we can do to pay less tax there, the biggest sort of weapon in your armory or tool that you have that you can use is to increase your pension contributions. More and more of us are being dragged into paying higher rate tax and additional rate tax bands because of the freeze on and thresholds, as I say. And these thresholds are due to remain frozen until 2031. And what has actually happened is because of that is that now we have 11% of the population paying higher rate of taxes compared to just 3.5% back in 1991, according to the fiscal studies. So more and more of us are paying tax at the higher rate. And it's not only people paying tax at the higher rate, the threshold where you pay tax at the top rate of 45%, that threshold was brought down a few years ago from 150 to 125,000. So you're being, the extra tax burden is coming at you in all directions. But one of the most effective ways that you can reduce your income tax bill is by increasing your pension contributions, because contributions to your pension are eligible for tax relief at the highest rate of income tax. So not only are you reducing your tax bill, but also you will be helping to build up a retirement fund. And the sooner you get money into your retirement fund, the more you'll benefit from compounding, etc. So I would suggest, have a look at what your income has been in this tax year, and especially if you are near that £100,000 threshold, look and see if you can make additional pension contributions to bring yourself back down below that threshold. On an ongoing basis, you might want to speak to your employer about increasing contributions to your workplace pension. And you might also just want to check that sometimes if you increase your pension contributions, your employer might match that or increase the contribution that they're paying. So you could be leaving money on the table unknowingly just now. So have a good look at, what your income is for this year. And if you do have some extra cash available just now, then think about putting that into your pension, and that will certainly save your tax bill for this financial year. Another thing you can do to reduce your tax liability is to make charitable donations. I'm sure we're all familiar with donating through gift aid, and you can tick that box to say if the charity can claim back tax for every £1 that you donate, or for every the money that you donate. But if you're a higher rate taxpayer, you can claim back the difference between the rate you pay and the basic rate of tax on your donation. So not only are you getting the chance to give money to charity and doing something good, but also you can potentially reduce your taxable income. Another scheme that might be open to you is salary sacrifice. So many companies offer salary sacrifice for your pension contributions, but some companies also offer the opportunity to salary sacrifice for different things like electric car vehicles and childcare vouchers if you're still entitled to join that scheme. So if you take advantage of the salary sacrifice scheme, then you can reduce your income tax just in a similar way as making pension contributions, because that money will be deducted from your gross income and you'll be taxed on what's left. So if somebody earning £50,000 opts to put £5,000 into their pension or into an electric car scheme, for example, then their taxable income that would pay tax on would be reduced down to £45,000, so lowering your income tax liability. So maybe speak to your employer about any salary sacrifice schemes that are on offer from your company. If you're married or in civil partnership, you might be able to claim marriage tax allowance, which can reduce a couple's tax bill by up to £252 a year. So the eligibility for this is quite restrictive, and it only applies where one person earns less than the personal allowance of £12,570. And effectively what they do is transfer 10% of their allowance to the higher earning partner. However, the higher earning partner cannot be earning more than £50,270. So the rules for who is eligible for that are quite specific, but you can apply for this allowance if you think that you might qualify via the government website. And also, if you realise that you are eligible for that, you can go back 4 years to claim for the previous 4 years. Therefore, that's something to definitely make sure you register for that before the end of this current tax year, to make sure that you can go back 4 years and one's not going to drop off the scale, if you like, when we move into the new tax year. So there's a few different ways that you can reduce your income tax liability. And, as I said, if you are somebody who is, earning more than £100,000, you really want to think about what you can do to reduce that liability, because when you lose your personal allowance on any income when you're earning income between 100 and 125, which effectively means you're paying an effective tax rate at 60%. So yeah, when you're earning around about that 100,000 threshold, you want to try and do what you can to bring yourself back below that, and making pension contributions is a good way to do it. It's even more important if you're a parent of young children. If you have children who are before school age and you're benefiting from child-free, the free funded hours, 30 hours free funded hours a week. If you earn more than £100,000, you would lose entitlement to that support. You also lose the entitlement to apply for child-free tax care. So if you find yourself in that situation, you definitely want to make sure that you make your pension contributions or do salary sacrifice or charitable gifts to get that down, your limit down below that 100,000. And another threshold you might want to be, for parents that you might want to be aware of, is that threshold for child benefit, because the amount of child benefit that you're entitled to, that reduces if you're earning between £60,000 and £80,000. It tapers off. But again, you can reduce your taxable income by making pension contributions. So, if you're in any of those danger zones, you really want to look at what you're doing, and can you use your pension contributions to move you away from those two thresholds. So moving on to tax on savings and investments, you might find yourself that you're paying income tax on any interest that you earn on your savings accounts, tax on dividends, and capital gains tax when you're selling assets. Therefore, you want to use all allowances possible to minimise this. So if we look at firstly on tax on investments, you want to use your capital gains tax-free allowance. So each person has got an annual exempt allowance that allows individuals to make gains of up to £3,000 in any tax year. 4 years ago, the amount of the exemption you had was 12,300, and now it's down to 3,000. So it has been really squeezed. So it becomes really more important that you are aware of any gains that you might be realising, because chances are what might a few years ago might not have caught you out and wouldn't have been taxable, it'll certainly be more likely to be taxed now. So it means that basic rate taxpayers are paying 18% on any gains above £3,000, and higher rate taxpayers are paying 24%. And again, this figure has increased in the last few years, up from 10 and 20%. So you really want to be on top of making sure that you are using that capital gains tax-free allowance. So, for example, if you were to sell investments that had a £5,000 gain, and these investments were outside your ISA or a pension, you wouldn't pay any tax on the first £3,000. But as a higher rate taxpayer, you would pay 24% on the remaining £2,000. So this means that you would pay £480 capital gains tax rather than £1,200 if you hadn't applied the capital gains tax allowance. So, even though the actual allowance of 3,000 is quite reduced from what it used to be, it is still certainly worth making sure that you are using that every year. So some ways that you can minimise capital gains is to use the ISA wrapper. The simplest thing you can do to reduce capital gains tax on investments is to make the most of your ISA allowance, which is £20,000 for each year. Because any investments that have that ISA wrap around them and in a stocks and shares ISA remain free from capital gains tax when you come to take the money out, and any dividend tax that may be earned while the money is invested. So this is a super way just to avoid capital gains. So you definitely want to make sure that if you haven't used your ISA allowance already for this year, that you use it, because if you don't use it, you lose it forever. So definitely make sure that you use your annual allowance for your ISAs. One thing you might want to do is, if you have investments that are outside an ISA, you might want to use a process called bed and ISA, which is this two-step process where effectively you sell your holdings that are outside the ISA and move it into, you sell it and then it's bought again, but it's under the wrapper of an ISA. So effectively you have the same portfolio, but it now has that ISA wrap around it so it can grow tax-free. There might find when you do that there is a capital gains liability. But again, this is where using your allowance can kick in. So another thing that you can do to make sure that you're limiting your liability for capital gains is to make sure that you have claimed for any losses. So if you have investments that have made a loss, then you can offset those losses against future gains which are made elsewhere. And you can sort of move these losses forward, and there's no time limit on the losses within which you have to use the losses, but there is a time limit within which you have to record that you have had an actual loss. So you want to make sure that you report any losses on any self-assessment that you do, or that you notify the Inland Revenue. And you can hold these past losses in reserve and use them ad infinitum, but past losses, they can be carried forward indefinitely, but you must report that loss within 4 years of the loss being made. So an action for you to take away is make sure you've notified HMRC of any losses that you've incurred within 4 years of the end of that tax year, or else you'll lose the ability to use that loss. So for example, if you had a loss made, in this year, then the deadline that you could claim to register that loss would be in April 2030. Something else that you might want to consider doing to minimise capital gains is to consider transferring some of your assets to a spouse. If your spouse earns less money than you and is in a different tax bracket, then you can minimise capital gains tax just by spreading the assets so that each of you can use your capital gains allowance. And also then you might be able to minimise any dividend tax that might be due if your spouse is a lower earning spouse. And also if you were to transfer assets as well, then your spouse might be able to use their ISA allowance if they're not using it already. Something else that you might want to think about doing, thinking about your tax on savings, you'll pay income tax on any interest which is earned from any savings that you might have. We all do have a personal savings allowance if you are a standard rate or higher rate taxpayer, but additional rate taxpayers, they don't have this. And under the personal allowance, a basic rate taxpayer can earn £1,000 in interest each year, and a higher rate taxpayer can earn £500 in interest. But now that interest rates are, for a while now, they've been a bit higher, sort of between 4 or 5%. If you're a higher rate taxpayer, you would only need to have £10,000 in savings, earning, and getting an interest rate of 5%, when you would find yourself that you have used up all of your personal allowance, and any interest earned above that would be subject to income tax. So you want to be aware of your personal savings allowance and maximise that by making sure you've got the right amount in savings on the right interest rate to make sure you're not going to be exceeding that allowance. But then also look at, can you use a cash ISA to get that ISA wrap around any other cash savings that you might have? Or again, would it be sensible to maybe move some of those savings to a lower paid spouse who might be in a different tax bracket? They might find that they have the basic rate personal allowance of £1,000. You might even find that if they have earnings of less than £17,500 approximately, then they benefit from an additional savings rate. So just think about how you can allocate your any cash that you might have between you and your partner to make sure that you're both maximising your personal savings allowance, you're both maximising any ISA allowance that you have. If you have children, you might also want to think about, can you use a junior ISA to shelter some money in there? You can open a junior ISA and save up to £9,000 a year for your child. But the big caveat with that is, and the thing to be aware of, is that when they turn 18, the money belongs to them. And so you might want to think about how you're perhaps adorable toddler just now, what might they be like when they're 18? And would you be quite happy for them to have access and you have no control over that money? So while that might be a tax efficient thing to do, there could be other consequences to it. So you want to be aware of that. And then the last tax to talk about is inheritance tax. This used to be something that applied to a small number of estates, but, with recent changes, in 2027, defined contribution pension plans are going to be accounted within your estate for inheritance tax purposes. So there's a lot more changes in the horizon. And it's calculated that, in 2028, the government will receive almost £10 billion in inheritance tax receipts. So if your estate does fall, or looks like that it's going to fall into that net and be subject to inheritance tax, then the simplest thing that you can do is actually try and give away money during your lifetime. So there's a couple of things that you can do. So one is, everybody has an annual allowance, and every individual gets a £3,000 annual gift allowance that you can carry forward for 1 year. So you certainly would want to use that. You also have an allowance of £250, which you can give to numerous people throughout each year. So in this tax year just now, you might decide to give £250 to your child, for example, and then after, from 6th of April, you could give them another £250, which is using up next year's annual allowance. By quirk, you cannot give them the 3,000 and the 250 because nothing's ever that straightforward. But there are different allowances there. If you find one of your children's getting married, there's another set of rules that applies, that you can make wedding gifts, and the amount of the gift that you can give depends upon the relation. So with children, you can gift them up to 5,000, grandchildren 2,500, and anyone else you can gift £1,000. So you can give that money away without worrying about any inheritance tax implications. And that money can be applied each time they're married. So if you have a serial marrier, somebody who's having more than one marriage, you can give them more than one £5,000 gift. The other thing that you can do is that there is a 7-year rule. So you can give away as much money as you want. And as long as you survive by more than 7 years, then that money is considered to be outside your estate. If you died within that 7 years, then it tapers. The amount of it that's considered to be inside your estate does taper down. And there are things that you can do to ensure that risk, within that 7 years. But you can try to minimise inheritance tax by getting rid of assets in your estate, hoping that you live for the 7 years, but you can take action just to, belts and braces, to make sure that that gift would be protected if it turned out it was going to be considered in your estate at a later date. So that's the main sort of things I want to say about, some ideas about how you can reduce tax. So some of these, I hope you've picked up that you need to take action before the end of the tax year. So notify HMRC of marriage allowances, any losses, etc., to make sure you lock in those allowances so that you're carrying forward, to make the pension contributions, etc. So you've got a list of things that you absolutely should done if you haven't done it already, giving you some ideas about things that you can do for better tax planning moving forward. So maybe thinking about transferring assets to spouses. You could do that. You might, if you suddenly realise that you can do that, you might want to do that before the end of tax year if you realise that, you can maybe transfer assets and do something clever with a bed and ISA, for example. But generally speaking, thinking about planning ahead, how can you transfer assets to make the most and reduce your tax bill moving forward? But I guess the one question I would have for you, is you're taking away a to-do list, and I hope this will give you an awareness of that you can take action to reduce your tax bill. There's so much doom and gloom in the press about tax bills, and we all know that we're paying more than we would like to do, but you can do something about it. And I guess the question I would have for you, if you're not doing something about it, what's stopping you? If it's because you don't have the information, and to be fair, who could blame you, because it's such a complex topic that it can be really difficult to keep on top of it. Is it that's stopping you from doing it? Is it because you don't have the plan? So just think about, what has stopped me from taking more tax efficient action this year? What can I do differently to make sure that next year is different and it's going to be better, and you're going to feel better organised and have better planning, and not scrambling about at the last minute, sort of looking for solutions. So a really good place to start is coming to events like this today and sort of being surrounded by people who have got that same focus. You might also want to take advantage of our free membership, which gives you access to lots of different resources that we have that you can join. So please sign up for that if you haven't done already. And just make sure that, looking after your finances just raises up your to-do list and something that you give your attention to. And to help you with that, we've got a few other events. We've always got events in the pipeline, things for you to come to. We've got another free finance on Friday at the end of April, 24th of April. And then on April, we have a money talk for Sapphics, if anybody would be interested in that, if it's relevant to them. And on the 11th of June, we have an Ask an Advisor session at 7 p.m, where you're welcome to come along and ask an advisor any questions. So let me just check the chat box to see if there's any questions. So one saying, I'm new to ISAs. I have one I opened in the current tax year. Do I have to leave it there, or can I move it to get a better rate? I'm also planning on moving some money to a new ISA in 26, 27. So yeah, you can move your ISAs about from one organisation to another to get a better interest rate. You can move it from a cash ISA to a stocks and shares ISA. You can have a cash ISA and a stocks and shares ISA running at the same time. But the maximum is £20,000 into both of them that you can invest in any 1 year. The important thing to note is, if you are planning to move an ISA from one place to another, you've got to go through a process. You cannot just close one account and then start a new account somewhere else, because then that will be considered to be that you have, you've used your ISA allowance up, and you don't, so you've got to go through that transfer process. So make sure you do that. There is a recording, and it will be sent out. Have they reversed the upcoming reduction to 2k in the salary sacrifice scheme? I saw there was rumours about that, but I don't think there's been anything certain publicised about how they're going to do it, if they are going to do it, or if they are going to scratch it. So I think that's still just topic to watch. So the maximum I can give to my 18-year-old to put into an ISA is 3k without there being any liability. No, so if you think that your estate might be subject to inheritance tax, then everyone can gift away £3,000 each year with there being no question, when the executors were looking at it, with there being no question with the fact that you have got rid of £3,000 of your estate. You can give as much to anybody as you want at any point in time, but just with the awareness that if my estate is subject to inheritance tax, and if I give them more than £3,000, then that gift might potentially still be considered to be part of my estate and might come into inheritance tax calculations. So yeah, you can give them more than 3,000, but it's just with that awareness that if inheritance tax might be relevant for your estate, then that gift might come back into the calculation when they're looking at your inheritance tax liability. Can I ask? Yeah, if you look on the website on the membership page, you will see there we've got access details about the 2 different levels of subscription service that we offer, and the criteria for which one would be relevant for you. So you can look for the Empower and the Enhanced levels, and yeah, you can see which one will apply. It's linked to a blog post there. Can you, it's a question, can you leave your old ISA where it is and start to invest in a new ISA? Yes, you can. You're not committed to the same ISA provider forever. I guess it's just one thing to, if you're making regular contributions into the one person, into one organisation, then you might want to just make sure you stop that. If you want to completely start your new tax year with the new person, just keep an eye on your direct debits, I guess. Where can I check my total yearly income without calling HMRC? Well, if you look at your, if you're employed, look at your payslip, that will have the information there. And then if you're self-employed, I guess if you're looking at your accounts and your invoices that you raised, that will tell you. Good, good. All right. Well, thank you for coming, everyone. I hope that was useful. I hope it hasn't sent you into mad panic thinking lots of things you've got to do in the next week or so. And yeah, I hope it's given you some food for thought about how to get organised for next year. All right. And I hope to come back to another session within the next time. See you again. Thank you. Bye-bye.